Hi everyone, and welcome to this webinar titled Planning for 2021. Thank you very much for joining. Do you remember doing a business plan at the start of 2020? I'm guessing like me, you threw that out the window when actually COVID hit. The key word for businesses in 2020 was pivot. Now, this webinar, we're going to cover off on some practical information on what we think business owners should be considering when they're developing their 2021 business plan. We've spoken to a lot of business owners as well as helping them out developing their 2021 business plan, as well as providing a sounding board in developing their own plan as well. And we wanted to touch on some key takeaways in the planning process that we think is relevant to business owners. Before we get started, I wanted to touch on why we're actually doing these seminars. We're really passionate about client success. It's in our culture. We feel that providing practical information to business clients to help business success is really our duty. It's the Rubik's care factor. And we feel that's what's different between us as an accounting firm compared to other accounting firms out there. Now, at Rubik's, we have over 350 client groups. So we can see what works and what doesn't work. And we'll be touching on now with this webinar on some of the aspects that we find that actually helps our clients. This webinar will be conducted in an interview style. We have such a strong client base and a really engaged one. We actually put out questions, we asked for questions to be sent in to us for this webinar that we'll answer today from our client base. And the topics we'll be cover off on is, first of all, reviewing budgets, cash flow, business plans, and business structures, banking and debt, tax compliance, job maker, and JobKeeper. We have received a stack of questions, and we'll cover off on some of the top questions that we've actually received in this webinar now. So joining me today is going to be Mark Debeljak and Eliza Smith, and I will be moderating the questions. But firstly, let me introduce Mark Debeljak sitting here. Mark is a director of Rubik's Business Accountants. He's a fellow of the Institute of Chartered Accountants, holds an advanced diploma in financial planning, has been advising small to medium-sized businesses for over 30 years. So there's a wealth of experience there. Has a great knowledge of self-managed super funds as well. So Mark, welcome.
Thank you, Stuart.
So the first question we received, has your client advice changed pre-COVID compared to post-COVID?
Well, Stuart, definitely the advice has changed. COVID threw up many difficulties, including closures of businesses, people being uncertain. So really cash flow is king in these uncertain times. Being conservative and keeping more cash in the bank has really helped a lot of our clients. And that's the advice I give to all clients every day, to make sure that you've got good cash and cash flow behind your business. Also too, there's a lot of government grants and subsidies around at the moment, and to make sure that your business is getting what you're entitled to. If your business has been affected by COVID, it's very important to make sure that you claim what you're entitled to. Another thing that has come up, especially in these times, is making sure you keep a great relationship with your bank. That's always very important. So if you are on tough times, that you can talk to your bank and they will help you out where they can. Most of our affected clients who had to close down during COVID or had to reduce their business during COVID are now starting to recover. In fact, some have fully recovered and grown in this last period. We've seen some of our clients actually flourish during this whole period, and it's good to see people taking opportunities to build their business in tough times. What we've seen as a business, as Rubik's, is there's plenty of opportunity out there, and that there are clients out there seeking these new opportunities, taking the risk, and actually building better businesses.
You mentioned opportunities there. What is the best business structure to operate a business out of?
Interesting question, Stuart.
Thank you.
You're welcome. We did another seminar series on structures, so I could sit here for 30 minutes talking to you about structures. What I think I'll do today is I'll talk about the 4 main structures that we see in business and maybe some interplay with them. So obviously you can trade in a business in your own name. You could trade in your business via a partnership, so 2 of us together. We could trade in a business in a operating company, so we're both shareholders and directors, or you can operate your business in either a unit trust or a family trust. Now, how you choose your structure is depending upon what you want to achieve out of it. Is it splitting income? Is it trying to limit taxation? Is it trying to protect assets? So the first 2 structures that I chose, partnerships and sole traders, aren't very good at those functions. A company is good at protecting assets and a company is good at limiting tax, but it doesn't have the flexibility of something like a family trust has. So really at the end of the day, it's about speaking to your trusted advisor, such as Rubik's, and discussing what you want out of your structure, but definitely a better structure will help achieve what you're trying to achieve.
So you've mentioned partnerships there. What if I am in a partnership? Can I change it?
Yeah, Stuart, that's another interesting question. So the answer is yes, but you need to make considerations of what the effects are. So in the past, if you change structure, you had to consider capital gains tax. So effectively what happens is if you change from a partnership to a company, your partnership has sold a business and your company has bought a business. Now, in the past, that would have had a tax outcome and you would have had to have accounted for that in some manner. Also, too, you need to think about things like stamp duty, because in some states in Australia, not in Victoria, but in some states, you might be charged stamp duty on the transfer of the assets across as well. I think something the government did a couple of years ago allows us now to actually roll from one entity to another, for example, from a partnership to a company, and we can take that as a capital gains tax free if we follow the rules. And we can also go from, for example, a partnership to a trust or a company to a trust as well. We just need to make sure that we follow the rules. So if you are thinking about changing your business structure, make sure you speak to your trusted advisor, such as Rubik's, to get the correct way of doing it.
So you're talking about business structures there. I own a home. Can a structure protect my home?
There's various answers to that question. In a long form answer, yes, a company can protect your home, but you need to make sure you do it in the right way. There's liabilities when you're in business. You're liable to your customers, you're liable to your employees, you're liable for taxation, you might have a bank borrowings. So all those liabilities are there, whether you're in a structure or whether you're doing it in your own name. The difference in a structure is if you're a good corporate citizen, then the liability rests with the company. So often you'll see a family trust set up with a corporate trustee. That's there to protect the business owners from the activities of the family trust. And the same with the company as well. But for example, if you trade while you're insolvent, there's no protection because you're making the conscious decision to trade while you are accumulating debts that you know you can't pay. Also too, there are some laws around tax and employee entitlements that you can't structure out of. So my advice there is, if you're using a structure to protect your assets, be a good corporate citizen, or at least have a chat with Rubik's and we'll make sure you're on the right path there, Stuart.
Thank you, Mark. So changing tact a little bit, you did mention banking and debts. I wanted to ask a couple of questions around that. I have an overdraft, a business overdraft, and it never seems to go down. Is that good?
In an answer, Stuart, no. Overdrafts are generally more expensive way of financing. They're often unsecured, but even if they are secured, because of the flexibility involved, you can have zero overdraft or you can have an overdraft that's fully drawn. Now, using the example, for example, if you have an overdraft that's 100 grand and for 12 months of the year, that sits at 95 grand, then really perhaps you'd be more suitable to a principal and interest loan, and thereby having a cheaper interest rate, maybe securing the debt so it's cheaper again, and having a repayment plan on that. So in the long run, you would be better. So it's also important to compare lenders. Some lenders will offer cheaper interest on overdrafts than other lenders because they have a different formula in the way they calculate it. So the answer to there is no, having an overdraft at full whack is not the right way to be.
You mentioned changing lenders, but we're finding more often than not, the banks are always wanting to see ATO accounts. How come?
The banks want to see your ATO accounts because it is an indicator of risk. And where I mean risk there, if you owe money to the tax office and don't have a repayment plan, the tax office at any point can put an order on the company to pay. So eventually they could put you into receivership, which puts the bank debt at risk because often the tax ranks higher than the bank in repayments. So that's why the banks are asking to see your BASs. That's why they're asking to see your ATO portal accounts. They want to make sure that you're doing the right thing with the banks because it reduces their risk.
I've heard another initiative that the government announced is a backed debt. What's that all about?
Stuart, at the beginning of COVID, the government realised that businesses will need cash flow because businesses were closing, they weren't able to get stock, that sort of thing. So the government introduced a loan scheme where they would back 50% of the loan. So the government guaranteed that 50%. And then the client would guarantee the other one. They were unsecured, and normally for an unsecured debt, you'd be paying a very high interest rate. Because it's half backed by the government, the interest rates are a lot less. And it meant that businesses who had short-term cash problems could go to the bank and apply for loans that was government guaranteed. Now that particular scheme runs out at the 30th of June. So if you're interested in joining that scheme, you probably need to be fast because that scheme is about to run out. They have announced another scheme that has a few more rules than the original scheme. The government will back up to 80%, so they'll back even a higher amount of the debt. There's an interest-free period of 24 months. The original scheme was 6 months. And they have capped the interest rate on that at 7.5%. Now, that's not the best interest rate you can get around town, but for an unsecured debt, that's not bad. Now, the one thing with this one is that you have to have been a business that was eligible for JobKeeper. So that does knock out a few clients and it's very targeted, but it is something that if you still at this period are on JobKeeper, it might be one of the ways to help you get through the next few months or the next few years as you put your business back together.
You mentioned debts a few times there. I've heard the bad debts. Oh, I've heard the word bad debts. What does that actually mean?
Good debt, bad debt. Some people say all debt's bad and that you shouldn't have debt. Now, I don't believe that because debt has its use. It helps you fund assets. It helps you fund your business. Bad debts is really where you're paying high interest. A good example of that is if you have a credit card and you don't pay that credit card off each month. You're paying 21% interest on that credit card. So that means that, for every 5 years, you've paid that credit card twice. So my solution to that is to probably take out a personal loan at a much lower rate. Potentially you could secure it against your house, which would be a much lower rate again. There's principal and interest repayments on that, and get that credit card so you're paying it off each month. Other bad debt is non-tax deductible debt. So for example, borrowing to pay off your credit card. Now you don't get a tax deduction for that. But for example, if you're borrowing to buy a rental property, now you do get a tax deduction for that. So if you have a home mortgage and you have a property mortgage for a rental, then you would focus your repayments on the non-tax deductible debt and keep the tax deductible debt at a higher amount. So that would mean that you use debt to your advantage, not to the banks.
Cool. Thank you very much for Mark. As you can see, Mark has a wealth of experience that should really be tapped in. He covered off on a lot of information there that we can go into a lot more detail around. And if you've got any questions around any of those things that Mark talked about, be it government-backed debt, banking, what to do with the ATO, as well as the appropriate structure for you, we can contact us. We will put contact details at the end of the slide, at the end of this presentation. So you can contact us as well. But what we might do now is start to move on to our next presenter, our next person to contact with. The next person we'll be bringing on is Eliza Smith. Eliza Smith has also got a lot of experience in advising business owners. Eliza actually joined Rubik's in 2017, but she has over 13 years experience in dealing with businesses across Australia, as well as the accounting industry. Eliza is also a chartered accountant, and she also has a real passion for working with businesses to drive success. She's a key staff member at Rubik's, and she looks after a large number of staff here, as well as a large number of businesses across Australia. She's also part of the Females in Accounting Network, which she co-founded. So she's got a lot of wealth of experience. So welcome, Eliza.
Thank you, Stuart. Good morning.
Thanks for joining me.
Thank you. Good morning, everyone. It's actually nice to be back face to face and
we're
seeing you
sitting
in person.
1.5 meters apart. So the topics that we've received that we're wanting to covers off on cash flow and budgeting.
Yes.
One of your favorite topics, I hear.
One of my favorites.
Yes. So one of the questions we received is, why is my cash flow and profit different?
Thank you, Stuart. And that question is probably one of the most commonly asked in the accounting industry. So there are a number of items that will appear in your profit and loss statement that will not appear in your bank statement or in your cash flow, and vice versa. So one of the first ones is depreciation. You'll see that in our set of accounts that we will send to you, but depreciation is a non-cash item. Therefore, it does not affect your bank account, but also will affect your profit and loss. The next one, as Mark was saying, was the repayments of tax. So if you pay down the ATO, that appears in your bank statement, but not your profit and loss. And thirdly, again, as Mark was saying, is the loan repayment. So the repaying of debt, whether it be an overdraft, credit card, personal loan, again, bank statement, but not your profit and loss.
Cool. So something that goes hand in hand with preparing a cash flow is a budget.
Yes.
Should I do one?
Absolutely. Everyone should do one. Even if you're on a wage, you should prepare a budget, right up to the high end of town and the big companies. Budgets are one of the most important planning tools. And I think with the COVID and what we've been through in the last 12 months, I think it's shown that you need that budget to prepare for things that aren't prepared for.
Cool.
Yeah.
So speaking of that, how often should you actually prepare a budget?
A budget should be prepared at least 12 months. Depending on the size of your business, it could be every month, every quarter, but then we'll review that against the actual performance. So that might be for every month what we compare against your budget with actuals, or every quarterly, or when we catch up with you for tax planning and year-end work.
Oh, yeah. So speaking of cash flow and budgets, is there an ideal amount of money that I should have in my bank account?
Well, that's the $1 million question, and I'm sure we'd all love $1 million in our bank account. Our rule of thumb, if there is one, is at least 2 months worth of operating expenses. So things such as your wages for your staff, your rent, overheads, things like that. If you have an overdraft, you can utilize, but we would like you to have that planning of having that amount in the bank account.
Cool. So we've touched on a couple key things that should be prepared. Another thing that I thought should be prepared is that I know what I need to do when I'm running a business. Should I actually prepare a business plan?
Of course you should. Whatever is in your head, I can guarantee you may not remember at the time of need. So part of our strategy on growing your business is that we actually write the business plan for you. We will sit down and go through all elements that we need to do, prepare it, and we'll also review it for you at tax planning and through our advisory work.
Oh, yeah. So I've heard that banks require business plans for lending. Why? Why? What do you have to do with that?
The banks want to see what your future plans are. So they want to see your goals. If you've got contracts coming up, tenders, they also want to look at the equipment that you own. They also want to look at your financials to see if you can actually pay off the lending that they're giving you. The business plan is their snapshot of the next 3 to 5 years of what you're aiming to do.
So going back to that then, so when I started my business, I prepared a business plan. Will that cut it?
Has things changed? They most certainly have. So a business plan should be reviewed at least every 3 to 5 years, or in some people's cases when the banks require one. But if there is big changes, so after COVID, I think our big push for our clients is to sit down and review and see what you want to grow, see what you want to change. You won't be able to expand your business if you don't do a business plan. So we suggest now is the great time to start preparing that business plan.
So you mentioned the word change in business. Speaking of change, if I wanted to sell my business in, say, let's say 3 years, do I need to put that in the business plan?
You do. So you need to plan for that ideal figure of what you want to sell, or that realistic figure of what you want to sell that business for. And then that way we can put goals in place and a path for you to reach that figure. So, you know, if you can't sell your business in 3 months and get that ideal figure, but if you do it over 3 years, we'll put it in the business plan, we'll set out your goals, the financials that you need, and it's something for you to strive to and something for us to review and check every year at least.
Cool. So thank you very much for that, Eliza. And as you can see, Eliza, again, has such a wealth of experience and knowledge in things in the business advisory space, and not just tax returns. So again, if you want to get in contact with Eliza around budgeting, cash flows and business plans and help developing your own, our contact details will be at the end of the slide. So we'll change tax now, where Eliza is actually going to ask me some questions. Eliza.
There we go. Here's a bit of a change. One of the big items that came out during COVID and the government support was JobKeeper. Now this is finishing soon. How is this going to impact businesses?
It's going to have a massive impact on business, we think. So I guess, as you mentioned, JobKeeper is expiring at the 28th of March, with the $1,000 payments per employee going to stop. The governments have announced that JobKeeper will not continue on past that date, as well as they've also announced that there's going to be no new government financial support planned around COVID. I guess with JobKeeper ending, you would potentially say that business is getting back to normal, whatever that means. Our advice to businesses that they need to start to proactively plan to deal without JobKeeper going forward if they haven't done already. I guess if you are a business that you are reliant on JobKeeper payments to actually pay your overheads, I think some tough decisions need to be made. Our advice would be to review your cash flow, as you mentioned already. Cash flow forecast is really explaining the health of a business to see if you're actually financially viable. So once you've actually done that, some of the solutions that could be in relation to cash flow forecasts is making some decisions on what to do with staff. Should there be some permanently reduction in employment? The next thing you should really do after reviewing your staff is, should you be going out and seeking further concessions from your suppliers, as well as your landlords? Should you having conversations with them, as well as your banks? Start speaking to them. And a bit more drastic measure would be around whether your business should actually be closed if you can't continue on after JobKeeper finishes. But that's a lot of negativity, Eliza. I don't deal in negativity. It's all about positivity. What are the opportunities now that JobKeeper is actually finished? This might be the push that you actually need to overhaul your finances and your operations that will actually make you a stronger business long term. How do you do this? I guess the first, as we mentioned already, is start planning. Start planning for the best scenario, as well as start planning for the worst scenario. And we can help you out with that. As mentioned earlier, potentially what you could be doing is restructuring your staff. The next thing you would be doing is reviewing your costs, seeing what's appropriate, trying not to dip into your savings. Reviewing your profitability of either your services or your products might be something you want to consider. I guess that will, identifying a more profitable service or product might be something that will identify whether you should be paying more attention to that one and focusing on that. Also streamlining your payables systems, as well as your accounts receivable systems, is really important too. Another thing that a lot of businesses have done during COVID is pivoting, as I mentioned earlier. So potentially building a recurring revenue stream, seeing that's an option as well. But I guess, as well as what Mark touched on, is reviewing your credit lines. Can something be done about that?
Thank you, Stuart. Now, at the moment, we are advising a number of clients on JobMaker, which was announced late last year as the next incentive. Tell us about JobMaker.
So JobMaker has got a lot of rules around it. So our advice initially is to contact us if you're thinking about doing it, because there's a lot of eligibility requirements to actually meet the JobKeeper payment scheme. But I guess I'll touch on it very briefly today, because again, there is a lot of rules. JobKeeper is a hiring scheme. It's a payment-based program to incentivize employers to actually hire people under the ages of 35.
How much can the employer get?
Yes, so first of all, I wanted to highlight what you just said. It's not the employee who gets the JobMaker payments, it's the employer. The scheme is actually split over 2 tiers. First of all, there's a payment for people who are under the ages of 16 to 29. The employers will receive $10,400 per year, as well as the next tier being 30 to 35, where the employer will receive $5,300 per year. Nice little cap.
It is, it's great. And can all of my employees get it?
So the answer is no. Again, here we go with a lot of the rules. Employers, first of all, must be eligible for the scheme, as well as they must have hired the employees during the period of 7 October 2020, and as well as the end date being 6th of October 2021. So an eligible employee, so these again, this is where a lot of the rules are. First of all, they need to be working 20 hours per week with the employer, as well as receiving for at least the last 28 consecutive days prior to engagement, job seeker or parenting payments or youth allowance. So there's a high eligibility requirement there, and we find that that criteria there is knocking out a lot of hirings already. Anecdotally, we're finding that a lot of employers are finding it really tough to get JobMaker out there because of that one.
They are. And on to our final topic, and your favourite topic,
Love
our compliance program. When lodging tax returns for our clients, are they eligible for an extension due to COVID?
So the short answer is no. There's no extensions in relation to lodgements of tax returns or BASs due to COVID. But I guess using a tax agent like Rubik's, you do get an automatic extension in lodgements of tax returns as well as BAS. A lot of our clients lodge their tax returns in May. Don't give us the information in May, give it to us way before then, as well as preparing quarterly BASs. You instantly get a month's grace when lodging your tax returns. So that helps out a lot of our clients. But I guess lodging tax returns as well as BASs is a necessary evil in running a business. We advise all our clients to obviously lodge their stuff on time. It is the best practice in running a healthy business. And I guess there's the second point is there's a flow-on effect if you don't lodge your stuff on time. Not lodging tax returns can impact your banking. So banks may not look at you in terms of lending if you haven't lodged either tax returns or BASs, as well as when dealing with the ATO, obviously they want you to lodge on time. They may not grant payment arrangements if you do have a tax debt, or they may not apply remission of any interest that they've charged if you haven't lodged things on time. Also, if you don't lodge BASs on time, you do run the risk of opening yourself up to director's penalty notice, which is not a good thing. Yes.
And that's the last of our questions.
Yeah, so in conclusion, we've touched on a lot of things that you can deal with in terms of putting together a business plan. We touched on a lot of information here. So if you do have any questions around anything we covered off on today, please contact us. Our contact details will be at the end of the slide. We're happy to answer any sort of questions. And also this video will be available for you to rewatch if you want to rewatch it as well. And what would be awesome as well too is actually if you can share this video with anyone in your business network who may or may not be interested in putting together a business plan, because we can certainly help you. And there's been a lot of information here that can be put together in terms of what a business plan should look like. So thank you very much for joining us. I hope you dealt with it because it's been fun.
It has. It's been great. And it's great to be back and advising businesses on escaping COVID.
Yeah, so cool. Thank you very much, everyone.
Thank you.